Good afternoon, everyone. If you are signing on for the first time to our Power Hour series, my name is Susan Damiani, and I am the Director of Gift Planning at St. John's University. I'm also the Director of the McAllen Society, which is our legacy society. And we've been having these Power Hours. It's actually number 7, lucky 7, John. And I hope everybody had a great weekend. Probably not the type of weekend that you normally would have, but I was just saying to a former classmate of mine this morning, if you are healthy and this weekend you're able to spend with family or talk to family, then you're ahead of the game and you can consider yourself blessed. I think at this point in the pandemic, as long as we're healthy and we can stay connected to our loved ones, then I think we can kiss, kiss the Blarney Stode, as they say, for that. So we are today going to have a conversation with John Ceparano. He's an alumnus of St. John's University. He graduated in 1985 from the business school. And I graduated in 87, so John and I knew each other in school. I'm trying to remember how we connected years later. I can't recall. But at any rate, I'm glad that we did connect. John has been a presenter for many of our Meet the Experts, which we usually have in the fall. We're planning to have it. It'll probably be virtual. But he's been a great asset to my office because he's really helped a lot of people with many of their questions concerning financial planning or choosing a financial advisor. So John, thank you so much. Thanks for joining us. I know today you are getting a roof on your home, so it's nice that you could break away and spend the hour with us today to talk about the CARES Act. I mean, it's been coming up a lot as a result of the stimulus package. And there are a lot of benefits to this CARES Act, and there's so many of them. So I thought it would be great to have John join us today and to explain some of the benefits and what we should be looking at our financial plans, especially during a pandemic. Let me just give you a little brief background on John. John Ceparano is a principal and is a principal and wealth manager with Modera Wealth Management, a fee-only wealth advisory office that provides an uncommon brand of financial and tax planning advice to successful entrepreneurs and retirees. He's also a C.P.A, which I think is great plus. So if you have any tax questions, we can ask them today. John's recommendations always pass through an income tax lens, and he is passionate about making people's lives simpler so that they can spend more time doing what they enjoy most, which is fantastic. So if you could tell us that today, we would really, really welcome that. So I'm going to turn the screen over, but just give me 1 minute if I can do this. Let's say you're not going to be with this, John. Let's say I can do this. We'll see what happens. Okay, here we go. I'm going to share my screen right now. I want to show you something. If I can find it. Of course, I can't find it now. Where is it? Oh, here we go. Do you see it? Does everyone see? Do you see it, John? Just nod your head if you see it. John was a cheerleader at St. John's University. It's so ironic that we should be doing this in May when it's commencement and graduating from St. John's. But I think John is all the way to the left. I believe that's you, John. I could be wrong. And then John's really going to kill me now. This is John's graduation picture. I hope you can all see it. So that was moons ago, but great memories, right, John? So I just wanted to share all of that. So there you go. All right, I'm going to turn it over to John. John, I'm going to turn my video and my audio off, and I'm going to give the screen to you. Thank you so much. Appreciate it.
Hello, everyone, wherever you are in the country. I'll turn on my presentation here. Let me see if I can get this just be a slideshow here for you. I appreciate Susan letting me work with St. John's. We've been working together for many years. I was teaching courses there about, 25 years ago. I started doing adjunct work with entrepreneurs and small business owners at the university. I live down in Florida, but I have offices in Boston, the New York City area, in New Jersey, in Atlanta, in Charlotte, and down in Florida. And I had a number of clients and friends that lived in the New York area, which I visit frequently, at least 3 to 6 times a year, typically, other than this time of year. And Susan and I have always stayed connected, at least for the last 10 years, it seems like. It was great to reconnect. But this year is uncommon for all of us. And with that came out some legislation. There was a lot of information that came out actually back in December with a new tax act. And then subsequently with the pandemic coming out, the CARES Act was initiated. So today what I want to go over are a number of opportunities, including the stimulus package. So we will go over, how might the stimulus package affect people? So the CARES Act was signed actually into law on March 27th in 2020. And the purpose was to assist Americans due to the economic hardship caused by the COVID virus. So it laid the ground rules for a lot of changes that were to come in the months past. But one of the first things that hit almost all individuals was the concept of getting people into people's hands. It was made law at that time, and they wanted $1,200 to go back into each person's hands to start. There are a second and third and fourth waves of additional legislation that came out, but the one that hit the average American was based on how much they made on either their 2018 or 2019 tax return, if it was filed. So based on that, they looked to see what your income was, and then it would get phased out and therefore go down to zero for, I believe it's every $5 for every $100 you go over $150,000 if you're married filing joint, or if you're a head of household, $112,500, and then for all others, which would be single people, it would be over $75,000. And that $1,200 was supposed to be coming out over the last month or so. They came out with additional information on that and said that it would come out by, of all dates, September 11, 2020. But if you have not received your check or know somebody who hasn't, they can simply go on to the IRS website, to irs.gov, and there is a few buttons to click. And basically, you could try to find out what your refund status is. You're going to have to give them your Social Security number, your filing status, and the refund amount that you expect. And based on that, they will give you correspondence supposedly within 2 weeks and let you know the timing when you should receive that. So you can go on to irs.gov and look at that. Those are some simple things that can be done for right now. So that's the starting point. So then the question came up, well, what other tax and planning opportunities were created by the CARES Act? People are asking. And by the way, anybody can pose questions to Susan, and I'll be glad to take a break and answer those questions. So where we were, I believe we were talking about the rebates, and we covered that. So then the next question is what is the most important date so far? It's been July 15th as it relates to taxes. So for federal returns across the country, everyone is required to have their taxes completed by July 15th for 2019. That includes both the filing and the payment. There are no penalties for late filing or payment, just as long as you file by July 15th. That also includes gift tax returns as well. But the thing that's very important are not all the states have followed the same guidelines. So for example, this morning I looked up New York. New York, for example, is having all their tax returns completed by July 15th, where New Jersey, they are also required to have their tax return completed by July 15th. But the estimated payments, if you're making them, are not due until July 15th for New York. But for New Jersey, the first payment is actually due July 15th, but the second payment, normally due on June 15th, is still due on June 15th. What's ironic and funny about that is that the actual first payment will be made after the second payment for New Jersey. Now, similar states have got some other cockamamie dates that they have. Most states are following the federal, but not all of them. So based on where you live, you can go online or ask your accountant, if you're using one, to tell you when your estimated payments are due for 2020. Your federal tax return may not be due until July 15th, but your state estimated payments will be due either before July 15th or on July 15th. So it's a state-by-state answer. Now, if you're like me in Florida, you don't have to worry about any state income tax. That's a nice perk. Next one here. Let's take a look at, here we go, require minimum distributions. They have been waived for 2020. So for those of you who were over 70 and a half at the end of 2019, you were either you have already been making or were normally required to make a required minimum distribution in 2020 based on the 12/31/2019 values of your IRAs. If and or 401ks for that matter. And if you were 70 and a half, you would normally be required. This year, because of the COVID-19 circumstance, they've stopped the distribution necessity or the requirement of it. And therefore, this year, you do not have to make that distribution to yourself. Well, you say to yourself, well, what's the benefit? The benefit is that for this year, you will not have to claim that income on your tax return. Now, some people who know some ways to give away money for charity know that if they do have IRAs and they do have required minimums, they're able to have what's called a qualified charitable distribution. And these qualified charitable distributions are able to still be taken out, but we'll get to those in a few minutes. Let's talk about people who did make some of these distributions already in the beginning of the year. Well, distributions that were taken from February 1st, but before May 15th, they're able to put that money back into their IRA so they do not have to pay the taxes on it right now. And you have to have that done by July 15th. So if you took out any distributions and you don't need the money, meaning you have other resources, either at home, so to speak, through one of your bank accounts, or you have another brokerage account that you can take out of, whether it's an individual, joint, or trust, you can take the money out of there. It will probably be less expensive for you tax-wise, because when you take money out of a cash account, there'll be no tax. And if you take it out of a brokerage account, the chances are that it's not 100% taxable, and you would also get taxed at capital gain rates instead of ordinary income tax rates. Certain types of income are taxed at higher rates. When you sell stocks, they're taxed, and you hold them over 1 year, they're taxed at lower rates. In this particular year, if you had large gains and the market had just gone down, you actually may have some losses that would be even more beneficial to you tax-wise to take some of that money out if you needed it. So from February 1st until May 15th, you're able to roll that money back into your IRA and therefore not get taxed. For those of you who took money out in January, you're not allowed to put that money back in. However, you may be able to convert that to a Roth IRA. It's called a Roth IRA conversion. And by doing so, you will at least put that money into a Roth that would not, that would not be taxed, that would be taxed no different than your IRA, but going forward, anything that it earns would be tax-free. So there are some benefits, and I would consider talking to your accountant about that to see if it could cause higher Medicare premiums, because as your income goes up on your tax return, your Medicare premiums can go up if they go past certain thresholds, certain income levels. Susan, always interrupt me if there's any questions along the way. Next. Sorry about this. How do I support my favorite charities that are hurting? Well, there was another law that came out that is a above the line, not having to itemize deduction on the front page of your tax return, so to speak. That's called a $300 deduction available to everyone that gives money to a charity. It has to be a 501c3 charity, and you can get the first $300 to reduce your taxable income, and you don't even have to itemize. Now, if, like I was talking about just a little earlier, you have qualified charitable distributions, there's still a big win, because you can get money out of your IRA that you're so inclined to give to charities in the first place and not pay for it with after-tax dollars by taking it out of your IRA. Why not after-tax dollars? Because none of the money in your IRA, for the most part, has been taxed. Most people who have money in their IRAs did that with pre-tax dollars. And if it comes out going to a charity before you have to, before you have to take it out, or required to here, this, if you are able to, if you want to give to charities and you're over 70 and a half, it will equal taking money out and meeting your required minimum distribution. So you can do that if you have not been doing that already. It's still good. They have not changed the age, and that is still 70 and a half. But there will be no deduction limit for itemizers either for charities. Charities used to be up to 50% of whatever your adjusted gross income was. 2 years ago, they changed it to 60%. Well, for this year, it's up to 100%. For those of you who are so inclined to give away 100% to charities equal to your income on your tax return, such as interest, dividends, capital gains, pensions, Social Security, rental income, whatever you have is coming in, it could be offset by the charitable deductions. Now, charitable deductions could wipe out that amount and could be carried over, but they can only be carried over up to 5 years. So you have to plan out not only how much you want to give, but to make sure that you could get the most benefit of it tax-wise by trying to take out the amount that you want, but not letting it go away or expire because you weren't able to offset other sources of income. So this is a planning opportunity for people to, especially when they know their sources of income within certain limits. The next thing I wanted to talk about was, whoops, here we go. Very sensitive, this clicker. Excuse me. Get there. There we go. How do I support my favorite charities that are hurting when I'm uncertain about the market? Many of you may have had a lot of anxieties over what just happened over the last 2.5 months for a number of reasons. One, for your own health, of course, number one, but also what happened to the market. And right now, the market has come up significantly since its low back in March. And some people who are typically charitably inclined would say, maybe I should hold off. And others may say, I don't mind giving to charities if I know that my sources of income every year or a cash flow comes to me. One of the ways to do that can be with a charitable gift annuity. In a charitable gift annuity, you donate a certain amount of money. They can typically be less than what we'll talk about in a second on charitable remainder trust. But under a charitable gift annuity, you give a certain amount down, typically around $10,000 or more, a lot less than typically what is put into a charitable remainder trust. And with that, you would get a fixed payment for life. You could tell them the time period or your life, and that amount will be fixed. Depending on when you do this, it will be based on the rates that are established by the IRS on how much your payments will actually wind up being. So this is something that Susan can help you with. The interest rates typically change monthly, and that can impact the amount of the fixed income you have. But at least you'll know that you'll be getting that payment for life. A good share of that will be the charitable deduction, but the actual payments for life will actually have a return of income to you, which will be a small piece that is taxable, kind of like interest. You can also start with small amounts compared to a charitable remainder trust. Now, there's pros and cons of charitable remainder trust, and that could be a whole presentation on its own. And I'll be glad to come back and talk about these different options. But basically, charitable remainder trusts give you more flexibility. You can have fixed payments. You could have variable payments depending on what you need. And you can also decide on how that money is invested, where with a guaranteed fixed income payment, they are fixed by the institution such as St. John's or a church. Those are the kind of things that could be very helpful, and we could talk about those in more detail. Okay. Oh, by the way, I did want to talk about something. When you take out money for your, when you put back money, I want to go back to the slide. This is very important for you. No? Over here on this slide. And you have your required minimum distributions and you roll them back. Many of you had federal withholding taken out from your required minimum distributions. And if you stop that payment from taking any more required minimum distributions or roll things back into the IRA, those taxes, depending on how you have things set up with your accountant, C.P.A, or on your own, they paid for either some or all of the taxes associated with your required minimum distribution. Now, many of my clients, in many cases, we don't do the required minimum distributions or a portion of it until the end of the year based on us doing tax planning for them throughout the whole year. And what happens is in many cases, a good portion of their required minimum distribution will go in, so they don't have to remember to make even quarterly estimated payments. So with that, if that money was to cover not only your required minimum distribution, which is 100% taxable, it would, in some cases, cover other sources of income that people have to make it easy for themselves, such as interest and dividends or even Social Security or pensions. If that is the case and you are not taking this year, you're going to have to either have withholding taken out of one of your other sources, such as Social Security or pensions, or you're going to have to adjust your estimated payments. So that is something you should really look at because it could go up or down depending on how you were having federal taxes taken out of your required minimum distribution. So I want to make sure I covered that with you. Okay, let's move back on here. Okay, what healthcare protections were added to me and my family from the CARE Act? We're turning away from taxes and numbers for a moment. Let's go over this. Testing and preventative services. Well, as part of the CARES Act, there's a typo up there at the top. That's pretty funny. Care protections. They have testing and preventative services. So what is included is insurance providers must cover the costs of the COVID cost associated with it, the testing. And once it is available, the vaccines will also be a permanent cost-free preventative service. Now, there may be other things that come out, kind of like for the flu every year, and they have free vaccines. They're going to basically be doing the same thing. Here's what's important, though, on other costs. The plans, including Medicare, are now required to cover telehealth services. So if there was any extra cost for you staying at home to be safe and to keep everybody else safe, but you still called in and let them look at your throat or your face or whatever is bothering you, rashes or anything that you have, it is included in those plans. Those plans may have some deductibles, but they are now included, so they're not an extra cost. For health savings accounts, flexible spending accounts, and other similar type plans, they've also expanded to temporarily cover the over-the-counter medicines without a prescription. And for many of you, you not only have prescription medications, but you also may have over-the-counter medications. My recommendation is that you call up your plan provider and find out what those items are to confirm that what you're buying, whether it's aspirin or whatever it is that you may have that you're taking, is covered. They have not defined, to my knowledge, they're still coming out to what defines temporarily. I've not seen that just yet. But it should be for this year or a portion of this year. So find out what over-the-counter medications you're able to take, and it should be covered by your health savings accounts and flexible spending accounts, which is typically your own money. So those are those covered care protections. Okay. The next question is, how much cash should I maintain? During these times, people get very anxious and they ask, how much cash should I maintain? Where is my cash? You know, where should I keep it? And is my cash FDIC insured? So speaking of that, cash typically should be kept in banks, CDs, money market accounts, or even brokerage accounts that have similar type of money market funds. That means that the money is liquid within the same day or the following day. And typically, how much should you keep? It depends on your other sources of income and how liquid it is. But for the most part, we recommend a minimum of 6 months to a year. Some people can have more than that saved, and it makes them feel comfortable. But typically 6 months of your expenditures that are not going to be covered by other sources of income that are coming routinely, such as pensions or Social Security. And is my cash FDIC insured? Sometimes people get confused about this. The FDIC insurance typically is $250,000 per depositor, per FDIC insured bank, and per ownership category. So if you're a married couple and you have an individual account, a joint account, and a trust account in the same bank, they could be covered up to $750,000. It depends on the category of or ownership of the account. So that's very important. Well, you still may be feeling anxious. What should I do? Well, a lot of times our emotions are like a roller coaster. And when there's good times, we are optimistic. When things get really good, we find a source of elation. Then when things start to turn the other way, we start to get nervous. And when things aren't turning back fast with us, or they're not temporary, meaning like a week or two or a month or two, people get fearful. And then it swings back up the way when things start turning around. This relates to everything that you're going through right now, as well as your investments, as well as the virus. People are at home right now. Many of you may be widows. Many of you may be single. Reaching out and staying in contact with people either through videos like this, or speaking to your loved ones or friends or acquaintances, and even if it's on the phone, can make you feel so much better. Don't listen to everything you read on the news or in the papers. It can be overwhelming because their goal is sensationalism. Stay focused on your health and stay focused on secure long-term planning. Well, we recognize that all of this is normal, and we know that this can be stressful, as I said, emotionally and financially, and we're worried about our health and our loved ones as well. So stay in touch with people. We're social creatures, and it's really, really hard to feel like you're part of something when you can't connect. You can't get a hug. You can't get a handshake. Can't get a pat on the back. Sometimes you can't even see their faces. So reach out to people. For us, I love what I do. I started out as a C.P.A. Then I went and got my master's in taxation so I can help people with their taxes and minimize their consequences and therefore keep more money in their pockets and in their savings account and in their investments. And then I'm also a certified financial planner. So we help people with all essence of their planning, from estate planning to income tax planning, to investment planning, to insurance planning, and of course, people in retirement. And we're basically a resource partner for the people that we work with. I've been working with many of the people through St. John's with Susan. So I'll be glad to answer any questions on any of these issues. And here's a way to get a hold of me to ask me any questions. All questions are free. Susan, let me turn it back over to you.
Thanks, John. If you can just mute your audio.
Yeah. Out here.
Thank you. We have one question right here. It says, according to the CARES stimulus package, is the stimulus check based on income of wages only or taxable income? For example, interest, dividends, etc.
Okay, can you hear me? It is based on all of your income. Typically, it's your adjusted gross income. And by the way, the CARES Act and all of the laws, they've been coming out and they're with answers to many of the questions like you just had, and it is ongoing. I am sure they'll continue to refine it, but it is based on your total income. And I think that is, as I remember, before deductions.
I actually have a personal question.
Okay.
My mom, she didn't receive the stimulus check. And someone told me that it was because she didn't file her 2019 taxes yet. Is that correct?
It could be. Checks for people where they do not have information about your bank account to send it directly are going to typically get checks later. There is a way to go on. I think I mentioned it earlier, but I'll give it to you. If you go on to irs.gov, there is, on that front of that page there is a sheet by the IRS that basically says how to claim your refund or get it faster, the status of your refund. And on there, all you have to do is go and give them your Social Security number, your filing status, and the expected refund amount. If you have not filed your 2019 tax return, they will base it on your 2018 tax return. So what's very interesting is that if your 2018 tax return was over the income threshold, but your 2019 is going to be below it, it behooves you to get your 2019 tax return filed now. Now, what's interesting is that they are going to look at actually your 2020 income, but there is supposedly, because there'd be so much confusion, so much political negativity, and this is regardless of who's in government, or now or then, quite frankly, is that there will be no what they call clawback. So they are pretty much going to base it on either 2018 or 2019, whichever is the last filed. So if 2019, however, was actually below the threshold, and 2019 is going to be above it, but you haven't filed yet. You may actually want to wait until closer to July 15th, because if you get it, there's a good chance that you will not have to give it back. So, circumstances.
They really like to make this confusing for us, don't they? Try to explain that to my mother. This is not easy. When they, if it's somebody who's not taking care of their finances, was never involved their entire life, to try to explain all of this it's crazy. It really is, to be honest with you. Just my little personal belief to get in there.
I work with a lot of people just like your mom, and basically I just go slow, not because they can't understand things, they just have never been exposed to many of these things. And quite frankly, what just happened over the last 2.5 months, none of us have been exposed to. And what's very interesting is that this legislation that came out, the CARES Act, was the fastest legislation that is so pervasive to all of us in the United States. It was passed in 10 days. In many cases, legislation is drawn up, put out, viewed by the public, viewed by professionals. It could take 3 to 6 months, and that's on a good situation. So it was clearly going to be confusing as soon as any legislation came out, not because these people did not work hard to get it out to create this stimulus package, but because of all the questions that would come out afterwards and the way that it works. I've also worked with a lot of small business owners, and you may have heard about it, this payroll protection program, and it has been ridiculously confusing. I led a team of professionals inside my company. We have roughly about 70 employees, and we put a task together when it first came out, and it took us literally a whole weekend just to understand the first wave of information that they gave us, which then subsequently has changed at least 3 more times, and has actually changed who qualifies for it and whether or not they should take it or not. So this is not going to be easy for everybody. Please be patient. Try to be as proactive as you can if you're interested, or you can wait. But if you have not got your stimulus check, you can go on irs.gov. They do have a place where you can go that you can click onto for status to find out where you're at. Be patient. They are inundated right now. I am not usually the biggest fan in the world of service by the IRS, but right now they can't hire fast enough to help people like us on this phone call just get some basic answers because they're overwhelmed. And if you think that's bad, what's even harder are each of the states dealing with unemployment. But that is a whole nother subject matter, state by state, on how some of their programs were not ready for this. The claims have been 4, 5, 10 times as much as they've ever experienced in terms of the velocity and how fast people have been putting in claims. And all these people need money while they're out of work until we can get everybody back to work. So I'm working with a lot of these people who are business owners. I'm working with a lot of retirees to help them with their anxieties, their portfolios, making sure their estate plans are up to date. So one of the things that Susan and I would love to hear from you about are the things that are on your mind, the things that we could follow up with. I'm very lucky and blessed that I work with a team that has got degrees such as mine and others as attorneys, CFPs, CFAs, worked in trust, banks and trusts, work with people and being very patient, help them out with their estate planning, charitable planning, like when you work with Susan, and the many ways that can be customized to meet your needs and help you take away some of the anxieties that money can bring in trying to make these decisions. Because these are the times when people need help the most. So thank you. Is there any other questions, Susan?
Yeah, no, thank you. I have another question. During this pandemic, so how should we be looking at our portfolio? Should we just step back and ride the wave, or should we be tweaking it a little bit? I know you said about the savings. A lot of people, unfortunately, some people are getting furloughed, they're getting laid off. So it's really important to have that 6 months worth of savings just in case that you need to rely on until you can get back to your job again and they're ready to bring you back. But, I know with myself, I have money in bonds and people are like, oh, stay away from bonds. So it's a little confusing. And then there's also, you're listening about all these different healthcare companies that are developing these drugs and vaccines. And then you're saying, wow, could I jump on the bandwagon now and maybe make myself some money if I buy their stock? Is it a good time to buy? So, what would you suggest?
Well, like everything else, the people who are trying to get at your money and trying to promote things now, some may turn out to be great, but the majority of them are just typically scams. When you go back to the basic investment philosophies, long before this pandemic came to play, which none of us could have anticipated in terms of how quickly the market went down, was that you should have had money set aside in the first place long before this, because we need to have some liquidity. So for argument's sake, if somebody needed each month $3,000 or $4,000 to supplement their Social Security and pension, or whatever amount of money it is, at the minimum they should try to have kept. This is not just in your month, 1 month's worth of money for your normal bills in your checking account, but I'm talking about setting it up with a savings account that could even be linked and making right now whopping 1.2 they may lock up your money for up to, depending on how long you leave in there, for 6 months, 2 years. But when you need that, you have. So as it relates to your portfolio, that income should have been set aside in the first. You could ride out the dips when they happen like this. Not gone down and has not fully come back like most people right now. It quite frankly is not different at the moment when we're just talking about the investments. No different than what happened back in the end of 2018. Within a 2-month period, people's portfolios went down by 10%. And then in 2019, the average portfolio that it was just 60% stocks and 40% bonds, which is fairly common, was up over 22%. So people, by just being patient, that also had cash on the side, were able to ride through that wave. Now, what I will suggest is this, is if you have a tax-savvy investment advisor, that means somebody who understands taxes, they're not looking just money. They're looking to make sure that you keep your money. So one of the things to do is to try to get a gift card. What is that? Well, when the market went way down, what we were doing for our clients, we were selling things that had losses. Now, some of our clients have been with us for 15 or 20 years. They only had short-term losses. They didn't have long-term losses because they had built up gains over many years. But some clients who only came on board with us in the last 2, 3, 4, 5 years had a few long-term losses. And what we did is we sold those securities, immediately bought something similar back, not the identical security, but something very similar, like in a mutual fund or a bond fund. And when we bought those back, they stayed invested. But when we sold them and they had a $2,000 loss or a $5,000 or a $10,000 loss, whatever it was, those losses now could be used to offset your future gains when the market is coming back and you're trying to rebalance your portfolio to stay at 60% stocks and 60% in bonds, so that as it's coming up and you're rebalancing, you're not paying the price for rebalancing later on. So these opportunities only come around when there are losses. And when those opportunities come around, it's equivalent of a free gift card with the IRS. Many advisors say, don't do anything and ride the wave. Well, I look at it this way. We like to be what I call actively passive. That means that we only try to rebalance when the market has changed, not in terms of the specific companies, because we believe it should be well diversified, because we cannot keep up and pick and know every single company that's out there in the United States. There's thousands, and the same thing worldwide. So with people that typically have less than $10 million in assets, which is the majority of people, they're able to get the diversity through mutual funds and ETFs at a fraction of the cost, with costs of less than 0.2% on an annual basis. It's extremely inexpensive, and many of the custodians now don't even charge for trading. So it's this is finding somebody that you can work with and can help you understand this. Put your mind at ease that your portfolio is well diversified, making sure that they are doing what we call tax loss harvesting when things are down, so that when they come back up, you're not paying taxes on those gains again. So stay diversified, stay patient, and make sure that you have the cash on the sidelines 6 months to a year or even longer, if that makes you feel more comfortable, knowing it's not going to make that much, but may let you sleep at night. And therefore, you can ride through these waves. Right now, the marketplace is basically only down about 45% right now compared to where it was down. And in many cases, between 2019 and 2020, the majority of our clients right now are still positive over the last 2 years, because they stayed patient and let us do what we do best, which is tax loss harvest when we can, stay diversified, and it can continue to take those distributions for those people who still need that income, and they're doing it over a long period of time and not panicking.
Thank you. No, it's so true. But obviously, this is a very unusual circumstances with uncertainty. So I understand when you say you may want to hold on to more cash than normal. I mean, I bought this MTA bond, and I thought it was the greatest thing. It was so secure. I mean, nothing's going to happen to the transit system in New York City. But the ridership has gone down, and I think we talked about it. My bond broker was trying to get me to sell it, which I didn't. I held on, and I still will continue to look at it, because I don't know, over the next year what the ridership will be and what will be happening to the MTA, and will that bond, will I be at risk with that bond? But again, you just never know, and that's sometimes those are the risks that I guess you have to take when you're investing. But when people say something is 100% secure, I don't think anyone will ever believe that anymore. That's for sure. And I don't think anyone should be saying 100% secure. But sometimes I will say, when they do pitch some of these bonds, they make it seem like, oh, you don't have to worry at all, and I kind of chuckle, because what's happening now, again, did we ever think that this would happen? But it is something, you do think about now moving forward when you do invest. Nothing is absolutely secure, wouldn't you say?
I'm sorry, you broken up there for a second. Can you hear me?
Yes.
Can you hear me?
Yes.
Oh, okay. Yeah, I think what people have to know is that individual securities have the risk of the individual company. And the companies sometimes are municipalities, which is what Susan was just talking about. So the way to diversify away that is to have bond funds or bond ETFs where they'll have hundreds of bonds. So even if one goes under, it is a small portion of your portfolio. You don't have to take that risk. And that's the biggest things that people don't realize. Bonds can lose a lot of money, especially if they are longer term bonds, because then they are subject to interest rate fluctuations. So if you had a bond that you bought that was a 10-year bond, and at the time you bought it, it was paying 4% 5 years ago or 4 years ago, and now interest rates have come down, you actually have a premium on that bond, unless the institution is having financial hardship. Then people looking to run, and people want to pay you pennies on the dollar. But if it's a strong company, but rates have gone down, your bond is worth something more. But when interest rates start rising again, your current bonds will probably not be worth as much. So my recommendation is to try to stay in short-term bonds with average durations of anywhere from, for argument's sake, a year to 7 years, with an average duration of about 4 to 5 years, because once you go out past that, it is really could fluctuate the same amount or even more sometimes as a stock. But the benefit of a stock is that you have tremendous upside potential. So there's a balance, and every individual investor has got to understand what's the balance of sleeping well at night and eating well during the day. So that is sitting down and trying to go over your hopes, your fears, and your goals, whether it's for your own needs or for your children's in the future. That's something where you really should be sitting down and playing it out and factoring the tax consequences of all these decisions together, because we don't want to make the government a partner in every deal for more than their share. And that's one of my biggest, that I profess a lot, is looking at the consequences of things. It doesn't mean that you shouldn't do things because it's going to be a tax. It just means that you should explore the options that you have and try to pick the one that is the most prudent investment with the least tax. And that's what we help people out with day to day.
Well, on that note, John, thank you so much for sharing your expertise with us today. I want to thank everyone. I know we're just getting off a long weekend, but thank all of you for joining us. Next week, Tuesday at 1 o'clock, if you want to feel like you are ready to go on a vacation, our professor will be taking us on a virtual tour through Tuscany and talking about all the wonderful wine and food that comes from that region. So I hope you join us next week for that. I have one last note from one of our attendees, Dorothea. She wants to say hi to you and Marianne. She's watching here with her mom. I don't know, Sue, can you unmute Dorothea?
Hi, John.
Thanks, Dorothea, for joining us. We appreciate it. Thanks, Dorothea, for joining us. We appreciate it. I'm sorry we had that little technical problem. I don't know, Florida and New York is not connecting very well today, but I think we got through it, right? So that's good. Well, thank you again, everyone. Congratulations to St. John's class of 2020 and to all of you that have graduates. It's certainly a resilient class, and we wish them all the best in their future. And if you have any memories of St. John's and your graduation, please email them to me, because we will pass them along to our graduates. I have 3 students that were working for me that graduated this year from St. John's, and I welcomed them into our St. John's alumni family, which I think is a solid, fantastic family to be part of. So as you can see, collaborating with one of my fellow alums is great. So thank you again. Have a wonderful afternoon, and we'll see you next week.